There are 3 stocks that I am buying in November as long as they hit the price I need them to hit, which is the most important aspect. Stock number 1, good old Nike. And Nike has been falling lately. $75 hit an all-time high of $179 on November 5th, 2021. It's almost 3 years ago exactly. All-time high of $180. Now it's a $75. People are starting to come out and say, oh, guess what? Nike's dead. They're losing market share, blah, blah, blah. Okay, well, Nike is not dead, as is evidenced by the P&L. Yes, their revenue the last 12 months is lower than last year, $50 billion versus $51.4 billion. But there's a lot of other things that I like about them. 1, gross profit of 45% and increasing. 45% gross margin means every unit they sell, every $100 they sell, $45 of that is profit that goes to pay overhead and the bottom line. So the faster and faster they grow this, the more units they sell, the higher and higher the profit will go. Second, you look at this and think to yourself, okay, they're doing more direct to consumer selling. That's a higher margin because before you have to sell to a wholesale, you have to sell to a retail spot, all these other places, and the margin's a lot smaller. So this margin over time should increase. Now, for those of you who love dividends, the last 12 months, this dying company has done $7.2 billion in free cash flow, while their 5-year average free cash flow is 4.7. That's a huge increase there. Puts their current price of free cash flow at 15.8. But remember, guys, this 15.8 could be a fluke. This $7.2 billion could be a fluke. We don't know exactly yet, but we have an increasing return on invested capital. This is a sign of a moat. It means that every dollar they invest in the business, they get a good return on. You absolutely need to pay a premium for these kind of companies. So the question is, what kind of premium should Nike get? But before we get in the numbers, let your Uncle Paul tell you some stories about Nike. The first thing to note is they don't manufacture their own shoes. That's split between Vietnam, Indonesia, and China. This matters because from a supply chain perspective, China's not the end-all be-all that everyone assumes it is, with Vietnam actually being more important supply chain from Nike. From 2005 to today, revenue is up 3.7x, net income is up 4.7x, and EPS, earnings per share, is up 6.7x. So you might ask the question, how is net income up 4.7, earnings per share up 6.7? Buying back shares. So as they buy back cheap shares, I would argue these are cheap and getting cheaper, hopefully, they're doing a better service for Nike investors. Guys, apparel is a tough business. Shoes are a tough business. All that change, all the fads that come and go, Nike stays pretty consistent. Yes, they have a blip going right now, but let me ask you a question. Do you think Nike's going to be around for the next 10, 20, or 30 years? Among athletic brands, Nike is number 1 with market share at 43.7%, and the brand value is number 1, ahead of number 2, Louis Vuitton, and number 3, Gucci. Nike has a desire to constantly spend to keep its edge. And so far, of course, this has worked. Nike has $10.6 billion of endorsement obligations, with $1.7 billion of that due in the full year 2024. But some of the biggest currently listed via Sports Brief are Ronaldo, LeBron, Kevin Durant, Nadal, all these people. Guys, they have a great roster of athletes, and it's only going to help them keep their competitive edge. Guys, and Tim Cook, the CEO of Apple, has been on the board of Nike for 19 years, well before he was even CEO of Apple. So let's go look at the analyst estimates for Nike. Guys, this dying company, 377 to 636 earnings per share. Pretty impressive here. Revenue growth, yeah, some fall here, but going from $52 billion to $66 billion in revenue. Again, these are analysts. We don't know if they're right or wrong. We're sitting here assuming these guys are going to look at the future of this company and deciding from there based on conversations where it's going. But like I said, if you think Nike's going to be around 10, 20, 30 years from now, where do you think their revenue is going to be 10 or 20, 30 years from now? Where do you think their profit and free cash flow will be? That's what's important. So of course, guys, the most important thing to do is, what is Nike worth to us? And this is why the stock analyzer tool is so important for us as investors. You shouldn't live and die by this tool, but the point of it is the future is unknown. We have to make assumptions about them. We have low, middle, and high assumptions to make. You need to put these in there. I'm going to put my assumptions in here, and it's going to tell me, Paul, based on your assumptions, this is what you need to pay to get an adequate return on your capital. That's all I'm doing here. And from there, I put my margin of safety in, but it's a great way to apply the numbers to our purchasing. So, first off, pretty consistent ROIC, which I love. Revenue growth. First line here of revenue growth. Low, middle, and high. I did 3, 5, and 7% revenue growth over the next 10 years. Profit margin. I did 10, 11, and 12%. And I assumed they were going to go a little bit higher due to the fact that they're doing more direct sales to consumers. And I did the same thing for free cash flow. PE. Guys, this is a premium company. I think it deserves a premium PE. I don't think this is one of those things where it's a fly-by-night company. I think it deserves 20, 23, and 26. But of course, you're the investor. You're the one who has to make the purchase decision, not me. I own Nike. I want to own more Nike. But the goal for you is, what I'm trying to do is teach a process. Never buy anything because somebody on the internet says they have it. Even Warren Buffett, if they have a stock, don't buy it just because he has it. Do your own research. I'm trying to teach that process. And guys, I put a 9% return in here. I don't want 9%, but the historical average for the S&P is 9 to 10%. So I'm looking at this saying, what is this company worth? And from here, I put my margin of safety in. I hit the analyze button. Wow, guys. I got a low price of 60, high price of 120, middle price of 85. I want to keep in mind, when we did Nike videos in the past, when it was at 150 plus, we were coming up with pretty similar numbers and people were saying, Paul, it's never going to go there. Well, we're at 75 today. If you bought it today, based on the middle assumptions, you can expect about a 10.5% return if these middle assumptions occur, and that includes dividends. Stock number 2, Paycom Software, another company that I own that I'd like to buy at lower prices. And ironically, we're doing the video today, and look what happened to Paycom. It's up 23% while the market is down big right now. So they just announced earnings, and they crushed. And guys, this is a company that had an all-time high here of $560 per share back in November of 2021. 3 years ago, similar to Nike, all the way up here, fell all the way as low in the last 52 weeks of 139.50. I was fortunate enough to buy it sub 150, hoping for it to continue on. Did not happen, but that's okay. Paycom has 36,820 clients, and it focuses its products on hiring, engaging, payment, management, and tracking of payroll. At the business's core, it just makes managing your business a lot easier. And guys, customer retention rates are very high, clocking it at 90% at the year-end 2023. And even though they have a lot of business relationships and clients, not a single client makes up more than 0.5% of their revenues. That's a very diverse client base. Paycom has a huge amount of white space for growth, given they only have 36,000, 37,000 clients, and there are hundreds of millions of small businesses in the world that would benefit from Paycom's offerings. So again, we go to the 8 pillars here. Guys, it's a 6-pillar thriller, not an 8-pillar thriller. And we do have really high multiples here, okay? But we also have a high return on invested capital that's growing. So there's a lot of potential here. Does this feel expensive? Absolutely. Absolutely does. But I do love the fact that they have a high return on invested capital, a high return on equity, there's a little bitty adorable dividend, but even better, $12 billion market cap with only a $14 billion enterprise value. So there's not a ton of debt there. In fact, their long-term debt to free cash flow is about 1.67 times. That's really low. Not buying back a ton of shares, which, they were pretty high for a while. It doesn't bother me at all. But you have revenue growth of $1 billion, led to net income growth of $300 million, led to cash flow growth of $200 million, with a lot of potential down the road. So let's see what analysts are saying. $8 per share EPS, growing to $14 in the next 4 years. That's big growth, guys. That is 75% growth. And revenue growth, double digits. 11, 11, 11, 14, and 11% revenue growth. So guys, there's a lot of potential here. And on top of that, they're software-based. Look at this gross margin, 83%. 83% gross margin, almost double what Nike is. Well, they also don't have a physical product, so that helps out a ton. Now, guys, there's a lot of data here. There's always a lot of data. There's always a lot of things to think about. And a lot of people who may have bought this company at $500 some see it fall, and your initial reaction is, I paid all this, now it's fall, I want to bail. But remember, it's about what's the company worth where you're currently at. And that's what our software community helps you to understand. Now, if you've been to our website, you've probably seen that we are limiting the number of daily spots to our community in software. And the reason for that is that we're completely and solely interested in having like-minded investors who can help each other with the data, the analysis, and more importantly, and this is very important, the emotional part of investing. I just had dinner yesterday with a great value investor friend of mine. And I said to him, I think value investing is like 95, 98% emotion. And he laughed and said, yeah, you're probably right. Any investing is. Successful investing and a successful life is about surrounding yourself with people who are where you want to be. And our community has thousands of members who are exactly that. And the community has grown a ton. And as it's grown, it's become less about me and more about you and how I can make life easier and more profitable for you. My team and I use every aspect of the software every single day. We use it by running our retirement calculator to make sure I keep my focus on the right things, analyzing our stock potential investments with our stock screener and our data, and also, guys, buying our real estate deals, whether they're big or small. I use it on single family homes. And I recently used it to buy a 200-unit property in Louisville, Kentucky that costs over $22 million. Now, if you're new to EM, you might not know this, but I used to work from an Excel sheet. And the most common question I got from viewers was, how do I get that software? And at the time I said, guys, you can't. It's expensive data. I pay for it. But then it led to a great idea. Why not just create this for the people who are asking for it? So here we are. And the great news is we're working behind the scenes to make this software better every single day. So before we make the changes and our current offer of all of this goes away, you can sign up today. And not only you get all the software data, all the tools, everything we've made so far, but you're also locked into your pricing tier forever. You get them all right now in one great easy deal. So if you're interested in having all the tools to analyze stocks and a supportive community that helps you sleep better at night and make more money, go to everythingmoney.com/sign up or click in the link in the description below and sign up before these changes occur. And I guarantee you, it'll be one of the best investing decisions you'll ever make. So what is Paycom software worth to us? Well, again, we go to our stock analyzer tool to give us a brief idea of it. So guys, I did 6, 8, and 10% revenue growth over the next 20 years. Let's go back to 10 years. I don't know why it's 20 there, but I'll go back to 10. And guys, this might be low. That's probably why I had it as numbers for 20 years. Analysts are expecting 10%, 11% plus growth for the next 5 years. So maybe this is low. Now, profit margin, 20, 23, and 26%. They did 26% last year. They've done 22% for the last few years. So I sat there and said, hey, with such a gross margin that's so high, maybe it can get better. Now, free cash flow, I'm going to assume it gets better, but I don't like the fact that it trails the profit margin. So it's something to consider here and do more research on before you own the company to make sure you're comfortable with it. Now for PE, I put in 17, 20, and 23 because they have an above average ROIC and a great gross margin. So I'm going to pay a premium for that. And finally, a 9% desired return. Again, no margin of safety, but it tells me what the company be worth to me today. Hit the analyze button, 115 to 130 on the low side, 260 to 280 on the high side, 175 to 200 in the middle. Guys, you can see why I jumped all over at sub 150. So I look at this saying, all right, based on today's price, it's probably going to be hard to make a decent return unless they really hit the high numbers of these assumptions, which I don't really like to make purchases based on that. Now, guys, keep in mind, it's up almost $40 today. So before, literally yesterday, this would have been a much better buy at, 170 or so? It would have been green all the way over here. But guys, that's what happens. But it's a good company to keep your eye on because it has a lot of volatility. And if we hit a recession, I imagine a company like this is going to be hit pretty hard. And it's an opportunity to buy a great company, what I perceive to be a great company at a better price for myself. Stock number 3, Southwest Airlines. Guys, I think Southwest Airlines is the best run airline in the airline industry. Not only is Southwest a well-run operator financially, but their customer service is high class, coming in second place in customer satisfaction in 2024, just behind Alaska Airlines. Now, even though Southwest is smaller, they are tied for second in total domestic passenger miles traveled. Delta has 17.8%, Southwest and American are both at 17.2%, United at 16%, and everybody else at 7.7%. Now, Southwest currently operates 817 planes versus 1,273 for Delta. United has 940 with plans to add another 700 by 2023. Plus, they have another 400 leased planes. Another thing Southwest does well is they keep their cost of fuel low. Here's how. They hedge. They're very big on hedging their fuel costs. They're like, listen, this is our biggest cost. Let's just operate a good business. Let's hedge our fuel costs. Here are some of the examples here. Profit margin has been negative for the last 5 years. if you look at before COVID, they were between 10 and 15% very consistently. So my theory is, okay, they have record revenue. They've had some short-term problems that are, I believe, temporary. And once they get back up to their 10 or 15% level of margin, what's the stock going to be worth? That's what's key for me on Southwest. It's purely a margin play. I look at it going, there's no way they're going to be losing. How can the company who made money 48 years in a row, never declared bankruptcy, suddenly permanently not be able to make money? Maybe they're just becoming another airline. That could be my flaw there. If I wake up 5 years, 10 years from now and the Southwest investment didn't do well, I would say, okay, well, probably based on that, it just became another airline. So let's see what the analyst estimates are for this company. Well, they have it going from 21 cents per share this year to $3.30 in a few years. The stock is currently at 31 bucks. So it has it for a single digit PE a few years from now. And guys, look at this revenue growth. 3 to 9%. 3.7, 6.6, 6.3, 9.3, 5%. Have them growing very, very consistently. All right, so there's a lot of potential here according to analysts. But again, I'm looking for short-term problems on great companies, and this is one of them. So, stock analyzer tool time, baby. All right, guys, I did 2, 4, and 6% revenue growth. I did 6, 8, and 10% profit margin and free cash flow. And guys, keep in mind, this is lower than the years before COVID. So I'm being conservative here even more so. I still think, to be honest with you, we should have it at 6, 10, and 14. I'm going to do that because I look at this saying 10 isn't like a home run for them. 10 is still on the low side of the previous numbers. PE, premium airline, in the sense of they're the best run one. I'm giving them a better PE than normal. I'm putting 16, 19, and 22. But let me be a little, I went higher on their profit margin and free cash flow margin. So I'm going to go more conservative on the multiple. I did 15, 17 and a half, and 20. And for desired return, I did 9%. Hit the analyze button. Guys, low price of 39, high price of 150, 145, middle price of 82. So I look at this saying, I wish I had 30 companies exactly like this to invest in with these kind of numbers, because I would do it in 2 seconds. Guys, if you want to see the 18 stocks I currently own, watch our next video. Thank you for your time.